Principles of Accounting 2, Chapter 14. In Chapter 14, we look at capital budgeting. So capital budgeting tends to fall in two major categories. We're screening decisions or we are creating preference decisions. So one are our different options or a proposed project, does it meet our standard of acceptance for projects based on different things that we have, such as return on investment requirements for projects? Or do we have a lot of different opportunities available to us and we're trying to decide which one is the best option for us? Some things that typically fall under capital budgeting decisions are major expansions, the decision to buy a new building, buy new equipment, replace equipment, looking for ways to reduce costs, and then doing a lease or buy decision. So whether we would lease office space or warehouse space, or if we're going to buy a new building. We have several different methods in which we evaluate capital budgeting decisions. The payback method, the net present value method, the internal rate of return. We're going to look at all of these different methods. So all of these methods focus on ways of analyzing the cash flows and costs associated with capital investment project. The simple rate of return method, which we'll look at last, focuses on incremental net operating income. We're going to look at each one of these individually. First, we're going to talk about how we look at cash inflows and outflows for capital investment projects. Cash outflows are the initial investment. So what does the investment cost? What are we buying? The incremental operating costs. So how much does this new piece of equipment cost to operate every year? Repairs and maintenance that are required on it. And then the working capital. So what assets are tied up as part of going into this process? Different cash inflows are any increased revenues from taking this position, reduction of cost. Maybe the machine we're looking at buying is more efficient than a machine that we had before and we're going to save money because of that. So we have a reduction of cost. The salvage value at the end of its useful life, and then the release of working capital if we have working capital tied up as part of the process. We also look at the time value of money when we're thinking about capital budgeting decisions. And the idea of the time value of money is that $1 today is worth more than $1 a year from now. And because if I invested $1 today and earned interest on it, I would have more money a year from now from that dollar than if I just received $1 a year from now. So it takes into consideration that I can invest that money and earn a return on it. So projects that promise earlier returns are preferable to those that promise later returns. And the capital budgeting techniques that best recognize the time value of money are those that involve discounted cash flows. So we discount them back to what their value is without that interest accumulation. And we will practice that. So the first method that we look at is the payback method. The payback method focuses on how long it takes to recoup our initial investment. So based on the annual cash flows that happen from this project, how long does it take to get back our main money? The payback method does take into consideration cash flows, but it does not consider the time value of money. You can, however, do the discounted cash flows payback period method that does take into consideration the time value of money. This is an example of the payback method. So this company is looking at installing an espresso bar in their restaurant. The cost is $140,000 and it has a 10-year useful life. We will generate annual net cash flows of $35,000 from this investment. We do not take on projects that have payback periods over 5 years. So we look at the payback period, which is the investment divided by the annual cash flows. So we end up with a payback period of 4 years on this espresso bar. Because it falls under the 5-year threshold that we have for projects, we would take on this project. So the advantages of using the payback method is that it's very quick and easy to calculate. It identifies projects that recoup the investment quickly, and it helps serve as a screening tool. Disadvantages are that it ignores the time value of money. It ignores any money we make after the payback period. And a short payback doesn't always mean that the investment is more desirable than any other investment. When we have uneven cash flows with a project, we can't use that payback formula. So we can't just, if we have even cash flows every year, we take the investment divided by the cash flows. But if the cash flows are different every single year, then we have to determine what the payback is based on the investment. So we have this example of an initial investment of $4,000. It has uneven cash flows. So in year 1, we recoup $1,000 of that investment. In year 2, we have 0 cash flows, and then in year 3, we have $2,000 in recoup. So we start year 4 with $1,000 left, and we make $1,000 in year 4. So that gets recovered in year 4. Another method that we look at is called the net present value method. The net present value method does look at time value of money. So the assumptions that we make with the net present value method are that all cash flows other than the initial investment occur at the end of periods, and all cash flows generated by an investment project are immediately reinvested at the rate of return equal to the discount rate. So our discount rate is also sometimes called a hurdle rate, but it's the rate we use for that required rate of return that a company has set as a threshold for the interest rate that we would invest at. So in looking at this example, we have information about a project that we're looking at. So we've been offered a 5-year contract to provide component parts for a large manufacturer. At the end of 5 years, we're going to release our working capital and use it elsewhere. So we have annual working capital that is required. We have special equipment that we need to buy. This equipment needs to be repaired in 3 years, and then at 5 years, it has a salvage value. We use a discount rate of 11%, so that's also called a hurdle rate or a required rate of return. Should we accept the contract? Well, the first thing that we need to calculate is what are the annual cash flows from operations. So we have sales revenue from parts, the cost of parts sold, and salaries. So first, we look at sales revenues minus the cost to get our annual net cash flows of $80,000. And then we look at our different investment opportunities. So we have the investment, which is $160,000. That happens now. We have working capital requirement that is $100,000, and that happens now. Then every year for a 5-year period, we're going to have annual net cash flows of $80,000. In year 3, we have to repair the equipment for $30,000. In year 5, we have salvage value of that equipment of $5,000. And then we have the working capital released at the end of year 5. So what the working capital requires is that we have some kind of a deposit or some kind of asset that is tied up or has to be set aside as part of installing this new machinery. If the net present value was positive, this means that we will recoup all of our investment dollars and make money, and we should accept the contract. What these factors are is from a time value of money table. So there are tables in your textbook that show you how to find the factor that we use for net present value. We'll also be looking at some examples where we use Excel formulas to calculate net present value. If the net present value is positive, then we accept the project because it promises a greater return than our minimum required rate of return. If it is 0, that means the rate of return of the project is exactly equal to our required rate of return. And if the net present value or NPV is negative, that means this project is not acceptable because it is less than our required rate of return and we will never recoup our investment. So how do we choose what that rate of return is, or our discount rate, also called a hurdle rate? It's usually our cost of capital. The cost of capital is the average return the company must pay to its long-term creditors and stockholders. Our net present value method automatically provides for return of the original investment. So in most of our problems, the discount rate is going to be given to us and we're not going to have to calculate it. The next method is called the internal rate of return method, or IRR. So the internal rate of return is the rate of return promised by an investment over its useful life. It's computed by finding the discount rate that will cause the net present value of a project to be 0. This method works very well if a project's cash flows are identical every year. If the annual cash flows are not identical, or if we have some years where we have negative cash flows, then it becomes much more complicated to determine that internal rate of return through calculations. We would want to use an Excel formula in order to do that. When we're looking at the internal rate of return, our cost of capital acts as a hurdle rate. So as I said, those are all just the same way to call our required rate of return, the cost of capital, hurdle rate, and discount rate are all just different ways of saying our minimum rate of return. Okay? If the internal rate of return is equal to or greater than our minimum rate of return, the project is acceptable. If the internal rate of return is less than, then the project is rejected. If we have even cash flows, we take the investment required divided by the annual net cash flows. And this gives us our present value factor for our internal rate of return. So we have the investment required of a new machine that's going to save us $20,000 a year in operating costs. It has a 10-year life. When we look then, we take this factor of 5.216 and we take that to our factor table. And what we look for is 10 years, and then we go across the 10-year table. So we would have years 1, 2 through 10. We take the 10-year and we go across until we find the number closest to the number we got. So we got the number 5.216. That tells us it's 14%. So the internal rate of return of this project is 14%. If our minimum required rate of return is equal to or greater than 14%, then the machine should be purchased. When we compare net present value and the internal rate of return methods, net present value is often simpler to calculate. We can calculate this by hand or using Excel. Internal rate of return, if there are uneven cash flows, gets very, very difficult to calculate, and you can only do it with software. We do have the assumptions that the internal rate of return method assumes cash flows are reinvested at the internal rate of return. If the internal rate of return is really high, this may be an unrealistic assumption. We can also end up with projects that return more than one internal rate of return when we have uneven cash flows. So it's more realistic to assume that our cash flows are going to be reinvested at our minimum rate of return, which is what we use in the net present value method.